How to Invest Like Warren Buffett, 20 Proven Principles That Made Him $100+ billion. Warren Buffett is worth over $100 billion, not from inventing a product, not from inheriting wealth, not from getting lucky with one big bet. He built his fortune purely through investing by following principles he shared openly for decades. Here's what's remarkable. These principles work whether you have $100 or $100 million. And in the next hour, you're going to learn all 20 of them with real examples from Buffett's life and exact steps you can take to apply them starting today. But first, an important disclaimer: investing carries risk, including the potential loss of your principal. What you'll learn here is educational, not personalized financial advice. Always do your own research and consider consulting a qualified financial advisor before making investment decisions. Now, let's dive into the principles that turned a kid from Omaha into one of the richest people on Earth. Principle 1. Invest in what you understand. Buffett has one simple rule: never invest in a business you cannot understand. If you can't explain how a company makes money in simple terms, don't buy its stock. In the late 1990s, everyone was getting rich on internet stocks. Tech companies with no profits were soaring 500%. Friends and investors criticized Buffett for missing out, but he stayed away. Why? He openly admitted, "I don't understand these businesses," and while others lost everything when the dot-com bubble burst in 2000, Buffett's portfolio stayed strong. He stuck to businesses he understood: insurance, banking, consumer goods. Buffett once said, "You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital." Look at his investment in Coca-Cola in 1988. He understood exactly how Coke made money. They sold a product people loved, had incredible brand recognition, and operated in virtually every country. Simple, clear, understandable. Compare that to his avoidance of Microsoft for years, even though Bill Gates was his close friend. He didn't invest because he couldn't predict the tech industry's future. Here's how you apply this. First, list industries you interact with daily: food, retail, healthcare, banking, entertainment. Second, identify companies whose business models you can explain to a 10-year-old. Can you describe how they make money, who their customers are, what makes them different? Third, create your circle of competence list. These are businesses you genuinely understand. Start here. Fourth, use the dinner table test. Could you explain this business to your family without confusing them? If not, pass on it. And remember, if you want to invest in a new industry, spend 6 to 12 months learning about it first. If you're finding value in this video, make sure you're subscribed. We're just getting started with these 20 principles, and each one builds on the last. Principle 2. Buy wonderful companies at fair prices. Early in his career, Buffett bought cheap, struggling companies, but he evolved. His partner, Charlie Munger, taught him, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett's biggest lesson: his investment in Berkshire Hathaway itself. In 1962, he started buying shares of this struggling textile company because it was cheap, trading below the value of its assets. Years later, Buffett called this his $200 billion mistake. The textile business was terrible. No matter how cheaply he bought it, it was a bad business in a dying industry. He eventually shut down the textile operations entirely. Buffett said, "When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact." The lesson stuck. When Buffett bought See's Candies in 1972 for $25 million, which seemed expensive, he was buying quality. See's had incredible brand loyalty, pricing power, and required little capital to grow. That expensive purchase has generated over $2 billion in profits. In 2016, Buffett began buying Apple stock. At first glance, Apple seemed expensive, but he recognized it as a wonderful business. Massive customer loyalty, recurring revenue from services, incredible profit margins. He didn't wait for Apple to become cheap. He paid a fair price for a wonderful company. That investment has generated over $100 billion in value for Berkshire Hathaway. Here's how you apply this. Stop searching only for bargain stocks. Instead, make a list of businesses you believe are truly wonderful. Companies with strong brands, loyal customers, and good economics. Identify what makes them wonderful. Do they have pricing power? Can they raise prices without losing customers? Do they have competitive advantages that are hard to replicate? Determine a fair price. Look at the price-to-earnings ratio. Compare it to the company's historical average and to similar companies. Fair doesn't mean cheap. It means reasonable relative to quality. Be patient. Keep your list and wait for fair entry points. This might mean waiting months or even years. When everyone panics about short-term problems, check if your wonderful companies are suddenly available at fair prices. And avoid value traps. Cheap companies in declining industries. Ask yourself, is this cheap because it's temporarily out of favor or because the business is deteriorating? Principle 3. Think long-term, 10+ years. Buffett's favorite holding period is forever. He doesn't buy stocks planning to sell them in 6 months or 2 years. He asks, will I be happy owning this company for the next 10 years, even if the stock market closed tomorrow? In 1988, Buffett bought $1 billion worth of Coca-Cola stock. In 1994, Coke's stock dropped over 20%. Many investors sold in panic. Buffett didn't even consider selling. He didn't check the stock price daily. He owned a piece of a business he loved. Today, over 35 years later, Berkshire still owns most of those original shares. That $1 billion investment is now worth over $25 billion, plus hundreds of millions in annual dividends. Buffett explains, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Compare this to the average investor who holds stocks for less than 1 year, constantly buying and selling, trying to time the market. Buffett bought American Express in 1964 during a scandal. Everyone was selling. He saw a great business temporarily in trouble. Berkshire still owns American Express today, 60 years later. See's Candies, owned since 1972, over 50 years. These aren't trades, they're ownership stakes in businesses. Here's how you apply this. Before buying any stock, write down why you're buying it. Include what would have to change for you to sell. When the stock drops 20%, reread your original reasoning. Stop checking stock prices daily. If you own quality companies, daily movements are just noise. Check quarterly or monthly at most. Use the 10-year test before every purchase. Ask, if I couldn't sell this stock for 10 years, would I still buy it? If the answer is no, don't buy it. Ignore short-term earnings misses. If your company has a bad quarter but the long-term story is intact, that's often a buying opportunity. Build a forever portfolio. Identify 5 to 10 companies you'd be comfortable owning for decades. Focus your research there. Before we continue, think about this. Are you investing for next month's gains or next decade's wealth? Your answer determines your returns. Let's keep going. Principle 4. Look for economic moats. An economic moat is a competitive advantage that protects a company from rivals, like a moat protecting a castle. Buffett looks for companies with wide moats, advantages so strong that competitors can't easily replicate them. Buffett often uses See's Candies as his example. When Berkshire bought See's in 1972, people asked why chocolates should cost more than competitors' products. The answer? Brand power. On Valentine's Day, a man buying chocolates for his wife isn't going to save $2 by buying an unknown brand and risk disappointing her. See's had such strong emotional connections that they had pricing power. Buffett said, in business, I look for economic castles protected by unbreachable moats. This lesson came partly from his Berkshire Hathaway textile mistake. Textiles had no moat. Anyone could make fabric. No brand loyalty, no unique advantage. It was doomed to fail. Look at Buffett's major holdings and you'll see moats everywhere. Coca-Cola? Brand moat. People trust the brand globally and pay premium prices. Competitors can make similar drinks, but they can't replicate 130+ years of brand building. Apple. Ecosystem moat. Once you buy an iPhone, iPad, Mac, and subscribe to Apple services, switching to Android means losing everything. The switching costs are enormous. GEICO. Cost moat. By selling insurance directly with no middlemen, GEICO operates at lower costs than competitors. They offer lower prices and still make good profits. Companies without moats struggle. Buffett learned this with airlines. They compete mainly on price because there's little customer loyalty. Most people just buy the cheapest ticket. Here's how you apply this. Before investing, identify the company's moat. Ask, what stops competitors from taking this company's customers? Look for 5 types of moats. Brand moat. Do customers prefer this brand even at higher prices? Cost moat. Can the company produce cheaper than rivals? Network moat. Does the product become more valuable as more people use it? Switching cost moat. Is it painful for customers to switch to competitors? Regulatory moat. Do licenses, patents, or regulations protect the business? Test the moat's strength. Imagine you have $10 billion to compete with this company. Could you take significant market share? If yes, the moat might not be strong enough. Check if the moat is widening or shrinking. Technology or competition could be eroding yesterday's advantages. Avoid commodities. If products are interchangeable, oil, steel, basic textiles, there's usually no moat. Principle 5. Be greedy when others are fearful. Buffett's famous quote. Be fearful when others are greedy, and greedy when others are fearful. The best opportunities often appear when everyone else is panicking. In September 2008, the financial system was collapsing, Lehman Brothers had failed, banks were going bankrupt. The stock market was in free fall. Fear gripped Wall Street. While everyone sold everything, Buffett did the opposite. He invested $5 billion in Goldman Sachs and $3 billion in General Electric. He wrote in the New York Times, "Buy American, I am." People thought he was crazy. Headlines were apocalyptic. Experts predicted another Great Depression, but Buffett saw opportunity. Those 2008-2009 investments earned Berkshire billions. The Goldman Sachs investment alone generated over $3 billion in profit. This principle worked throughout his career. American Express in 1964, the salad oil scandal tanked the stock. Buffett bought heavily while others fled. It became one of his best investments, Washington Post, in 1973. During a market crash, he bought nearly 10% of the company at a fraction of its intrinsic value. COVID-19 in March 2020, investors who bought during the panic saw massive returns over the following 2 years. The pattern is clear: maximum pessimism creates maximum opportunity. Here's how you apply this. Keep a fear gauge list. Write down 5 to 10 quality companies you'd love to own but seem too expensive today. Check their prices during market panics. Prepare cash reserves. Keep 10 to 25% of your portfolio in cash so you have dry powder when fear strikes. When everyone is greedy, build cash. When everyone is fearful, deploy it. Create a crisis checklist before the next crash. Right. When the market drops 20%, I will invest X amount. When it drops 30%, I will invest Y amount. Having a plan prevents emotional paralysis. Distinguish between fear and fundamental problems. Fear is temporary panic about good companies. Fundamental problems mean the business model is broken. Buy fear. Avoid broken businesses. Use headlines as a contrary indicator. When newspapers scream, "Is this the end of the stock market?" that's often the best time to buy. Start small during fear. You don't have to invest everything at once. Buy in increments. If stocks drop another 10%, buy more. We're at Principle 5 of 20, and you're learning strategies most investors never discover. Stay with me. The next principles get even more powerful. Principle 6. Margin of safety. Never pay full price for anything. Always demand a margin of safety, a buffer between what you pay and what something is actually worth. This protects you from mistakes and unexpected events. Buffett learned this from Benjamin Graham. If you calculate a company is worth $100 per share, don't pay $100. Wait until you can buy it for $60, $70, or $80. That discount is your margin of safety. Buffett applied this buying the Washington Post in 1973. He calculated the company was worth $400 to $500 million. He bought his stake when the market valued the entire company at just $80 million, an 80% margin of safety. Even when Buffett makes mistakes in his calculations, the margin of safety protects him. He said, "You don't have to be precisely right. You just have to avoid being badly wrong. Contrast this with investors who chase hot stocks at any price. In 2000, investors paid 100+ times earnings for dot-com companies with no margin of safety. When those companies failed to meet expectations, investors lost everything. If they'd paid 10 times earnings instead of 100 times, they could have been wrong about a lot and still made money. Here's how you apply this. Calculate intrinsic value before buying. Use simple methods. What would a private buyer pay for the whole company? How much cash will this business generate over 10 years? What are similar companies selling for? Apply the 30 to 50% rule. Once you calculate what a stock is worth, only buy if you can get it for 30 to 50% less. This is your margin of safety. Use multiple valuation methods. Don't rely on one calculation. Use 3 to 4 different approaches. If they all point to similar values, you can be more confident. Be conservative with growth assumptions. If a company has grown 20% annually, assume 10 to 15% in your calculations. Better to be pleasantly surprised than disappointed. Increase the required margin for riskier businesses. Stable companies might only need a 30% discount. Volatile businesses should require 50% plus discount. Walk away from fair prices. Great returns require great prices, not average prices. Principle 7. Focus on quality management. Buffett invests in companies run by honest, capable managers who treat shareholders like partners. He says, I try to invest in businesses that are so wonderful that an idiot can run them, because sooner or later, one will. When Buffett invested in Geico, he bet heavily on CEO Tony Nicely, who started as an entry-level employee in 1961 and worked his way up. Nicely understood the business intimately and ran it with shareholders' interests in mind for decades. Buffett looks for managers who love their business, not just their compensation, managers who own significant stock themselves, investing their own wealth alongside yours. One of Buffett's key questions: if you had to go away for 10 years and could only invest in one business run by one person, who would you choose? Nebraska Furniture. Mart. Buffett bought this from Rose Blumkin, who started the business with $500. She was in her 90s when he bought it, and he did the deal on a handshake. No audit, no due diligence beyond knowing her character. Apple. Buffett eventually invested partly because of Tim Cook's capital allocation skills, returning billions to shareholders through buybacks and dividends rather than empire-building acquisitions. Here's how you apply this. Research the CEO before investing. Read their shareholder letters. Do they speak plainly and honestly or use jargon and make excuses? Check insider ownership. See how much stock the CEO and executives own. If they're not invested significantly, why should you be? Look at capital allocation history. What has management done with profits? Do they reinvest wisely? Return cash to shareholders, make smart acquisitions, avoid wasteful spending? Examine executive compensation. Is it reasonable relative to performance? Are executives paid based on long-term results or short-term metrics they can manipulate? Read the risk factors section in annual reports. Good management discusses risks honestly. Poor management minimizes or hides problems. Look for consistency. Has the same management team been successful for 5+ years? Constant executive turnover is a red flag. Trust your gut about character. If a CEO seems dishonest or overly promotional in interviews, stay away. Integrity matters. Principle 8. Understand the difference between price and value. Price is what you pay. Value is what you get. They're often very different. The stock market is emotional. Prices fluctuate wildly, but the underlying value of good businesses changes slowly. Buffett loves to quote Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Short-term prices reflect popularity and emotion. Long-term prices reflect actual business value. During the 2008 crisis, Wells Fargo's stock dropped from over $30 to under $9, a 70% decline. Did Wells Fargo become 70% less valuable overnight? No. The business was fundamentally the same. The price changed, but the value hadn't. Buffett bought heavily during this panic. He explained, "Price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down." Washington Post. Buffett bought at $5 to $6 per share in 1973 when the company was deeply unpopular. He calculated it was worth $40 to $50 per share, nearly 10 times the price. Over time, the price rose to meet and exceed the value. Here's how you apply this. Stop looking at stock charts. Price charts tell you about emotion and momentum, not value. Focus on business fundamentals instead. When a stock you own drops 20%, ask, has the value of this business decreased or just the price? If the business is intact, falling prices might be a gift. Calculate value independently. Before looking at the current price, estimate what you think the company is worth. Then compare your estimate to the price. Use the private business test. Ask, if I could buy this entire business privately for the current market value, would I do it? Track the difference between price and value. When the gap is wide, price much lower than value, invest more. When price exceeds value, invest less or sell. Remember that volatility is not risk. A stock that bounces around in price but represents a stable business is not risky. A stock with a steady price but deteriorating business value is very risky. Principle 9. Don't try to time the market. Buffett doesn't predict market movements. He doesn't know if stocks will go up or down tomorrow or next month, and he doesn't care. He says, I never have an opinion on the market because it wouldn't be any good and it might interfere with the opinions we have that are good. When he bought his first stock in 1942 at age 11, he had no idea World War II would last another 3 years. When he invested heavily in the 1960s, he didn't predict the brutal bear market of 1973-1974. When he bought stocks in 2008, he couldn't have known exactly when the market would bottom. Despite all this uncertainty about timing, his returns have been extraordinary. Not because he timed the market, but because he bought good businesses and held them. Buffett says, the stock market is designed to transfer money from the active to the patient. Buffett's 2008 New York Times article. In October 2008, with markets crashing daily, he wrote, Buy American I am. He wasn't calling the bottom. Stocks fell another 25% over the next 5 months, but he wasn't trying to time the exact bottom. He was buying value when it appeared. Studies show that even professional market timers are wrong most of the time. If you missed just the 10 best days in the market over 30 years, your returns would be cut in half. The problem? Those best days often come during the worst times. Here's how you apply this. Eliminate market prediction from your strategy. Don't ask, will the market go up or down? Instead ask, is this a good business at a fair price? Invest regularly regardless of market conditions. Dollar cost averaging, investing the same amount monthly, removes the timing decision entirely. Stop reading market forecasts. Economists and strategists are consistently wrong about market direction. Their predictions add noise, not value. Use market timing against itself. When everyone predicts doom, that's often the best time to buy. When everyone predicts endless growth, be cautious. But don't wait for perfect timing. Stay fully invested in quality businesses. The best time to hold stocks is all the time if they're good businesses. Remember that time in the market beats timing the market. Staying invested the entire time yields better returns than trying to jump in and out. We're halfway through the 20 principles. If you're still watching, you're serious about transforming your investing approach. Let's keep the momentum going. Principle 10. Keep it simple. Buffett built a $100 billion fortune using simple principles anyone can understand. He avoids complex derivatives, exotic investments, and strategies that require a PhD. There seems to be some perverse human characteristic that likes to make easy things difficult, he says. At Berkshire's annual meetings, shareholders sometimes ask about complex financial strategies. Buffett's response is always similar. I don't understand it, so I don't do it. This isn't false modesty. Buffett really does stick to simple investments, businesses that make products people buy, companies with earnings you can predict, stocks you can value with basic math. When Buffett bought See's Candies, the analysis was simple. People love the chocolates, they pay premium prices, the business generates cash. No complex formulas needed. When he avoided the 2008 financial crisis's worst damage, it was partly because he'd avoided complex mortgage-backed securities. He said, "I can't tell you what's in those things, so I don't invest in them." Warren Buffett's most complex financial insight. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Simple, but powerful. Here's how you apply this. If you can't explain an investment in 3 sentences, don't buy it. Complexity is not sophistication, it's usually confusion. Avoid products you don't understand. Structured notes, exotic ETFs, complex option strategies. If you need a manual to understand it, skip it. Use simple valuation metrics, price-to-earnings ratio, dividend yield, return on equity. These basic metrics work fine for most investors. Ask the grandmother test. Could you explain this investment to your grandmother? If not, it's probably too complex. Remember that simple doesn't mean easy. Finding great businesses at fair prices is simple to understand but requires discipline and patience to execute. The best investments are often boring. Utilities, consumer staples, insurance. These aren't exciting dinner party topics, but they've made Buffett billions. Principle 11. Focus on cash flow, not just earnings. Earnings can be manipulated through accounting tricks. Cash flow is real. Buffett says, in the end, all earnings must become cash, or they're worthless. Companies can inflate earnings with aggressive accounting, recognizing revenue early, capitalizing expenses, using creative depreciation. But cash flow is harder to fake. Either cash is coming into the business or it isn't. Buffett looks for businesses that generate strong free cash flow, cash left over after paying all expenses and necessary investments. This cash can be returned to shareholders or reinvested in growth. See's Candies is Buffett's favorite example. The company required minimal capital investment, no expensive factories or equipment. It generated cash year after year. That cash could be used to buy other businesses. Contrast this with capital-intensive businesses. Airlines need to constantly buy new planes. Manufacturers need new equipment. These businesses might show profits on paper, but consume all their cash just to stay competitive. Buffett asks, how much cash does this business generate that owners can actually take out and use elsewhere? Here's how you apply this. Look at the cash flow statement, not just the income statement. Find the line operating cash flow and free cash flow. Calculate free cash flow, operating cash flow minus capital expenditures. This is the real cash available to owners. Compare free cash flow to net income. If free cash flow is consistently much lower than earnings, be skeptical. The company might be using accounting tricks. Look for businesses with low capital requirements. Software companies, brands, service businesses, these often generate more cash relative to their earnings than heavy industry. Check if the company pays dividends or buys back stock. If management returns cash to shareholders, it shows the business generates real excess cash. Be wary of companies that always need to raise money. If a company constantly sells new shares or takes on debt despite showing profits, those profits might not be real. Principle 12. Reinvestment returns matter. It's not just about how much profit a company makes, it's what they do with that profit. Buffett looks for companies that can reinvest their profits at high rates of return. Imagine 2 companies. Company A earns $10 million and can reinvest it to earn 30% returns. Company B earns $20 million but can only reinvest at 5% returns. Company A is more valuable because its profits compound faster. This is why Buffett loves businesses like See's Candies. See's generated cash but didn't need to reinvest much in the business. Buffett could take that cash and reinvest it in other businesses earning high returns. Compare this to an airline. Airlines might be profitable, but they have to reinvest massive amounts just to maintain their competitive position. New planes, terminal improvements, technology. Those reinvestments earn low returns. Buffett says, the best business to own is one that, over an extended period, can employ large amounts of incremental capital at very high rates of return. Amazon is a good example he doesn't own, but illustrates the principle. Amazon reinvested every dollar of profit back into the business for years, and those reinvestments generated huge returns as the company grew. Here's how you apply this. Look at return on equity, ROE. This shows how much profit a company generates relative to shareholders' investment. Look for consistent ROE above 15%. Check return on invested capital, ROIC. This shows how efficiently a company uses all its capital. Companies with ROIC above 12–15% are usually good businesses. Read shareholder letters to understand management's reinvestment strategy. Do they have good opportunities to reinvest profits, or do they return cash to shareholders because they can't find good investments? Favor companies that can reinvest at high returns. These create compounding machines that grow wealth exponentially. Be cautious of companies that hoard cash. If management sits on billions in cash earning 1–2% instead of returning it to shareholders or reinvesting it well, that's value destruction. Principle 13. Understand the business's economics. Some businesses have great economics. High margins, low capital needs, strong returns. Others have terrible economics. Low margins, high capital needs, weak returns. Buffett focuses on the former. He explains the difference with two examples: newspapers, when he invested decades ago, and airlines. Newspapers in the 1970s, 1990s, high profit margins, local monopolies, low capital requirements. Advertising revenue was sticky, great economics. Airlines, low profit margins, intense competition, massive capital requirements. Customer loyalty is to price, not brand. Terrible economics. Buffett famously said, "If a capitalist had been present at Kitty Hawk back in the early 1900s, he should have shot Orville Wright. He would have saved his progeny money." The lesson: even if an industry serves an important function, airlines transport millions, that doesn't make it a good investment. Buffett looks for businesses with high gross margins, keeping most revenue as profit, asset-light models, not much equipment or inventory needed, recurring revenue, customers come back, automatically. Pricing power, can raise prices without losing customers. Here's how you apply this. Check gross profit margin. This is revenue minus cost of goods sold divided by revenue. Look for margins above 40%. Higher is better. Examine capital intensity. Look at property, plant, and equipment on the balance sheet. Asset-light businesses, low PP&E relative to revenue, usually have better economics. Identify recurring revenue. Does the company have subscriptions, contracts, or repeat customers? Or does it have to fight for every sale? Test pricing power. Has the company raised prices faster than inflation over the past 5 years? If yes, it has good economics. Compare economics within industries. Some industries naturally have better economics than others. Within any industry, find the best businesses. Avoid commodity businesses. If the product is interchangeable and competition is purely on price, economics are usually poor. Principle 14. Invest in 14. Businesses, not stocks. Buffett doesn't see himself as a stock picker. He sees himself as a business owner. When he buys stock, he's buying a piece of a business, and he thinks like an owner, not a trader. He says, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years." This mindset shift is powerful. Stock traders think about price movements, charts, momentum. Business owners think about sales, profits, competitive position, management quality. When Buffett bought Coca-Cola, he wasn't predicting where the stock would go next quarter. He was buying a piece of a business that sold beverages to billions of people worldwide. This owner's mindset makes you ask different questions. Is this a good business? Do I understand how it makes money? Will it be stronger in 10 years? Would I be happy owning the entire company at this price? Traders ask, what will the stock do next? Weak? What are the technical indicators showing? What's the momentum? Buffett's approach means ignoring daily stock fluctuations. If you owned a local business, say a restaurant, you wouldn't check its value every day based on random offers from strangers. You'd focus on whether the restaurant was serving good food and making profits. Here's how you apply this. Before buying, ask, would I buy this entire business privately at this valuation? If not, don't buy the stock either. Think in terms of ownership percentage. When When you buy 10 shares, you own a tiny piece of the business. Think about what you own, not what you can trade. Read annual reports like an owner. Focus on the business sections: operation, strategy, competitive position. Ignore the sections about stock price and investor relations. Measure success by business performance, not stock performance. Is the company growing sales, improving margins, gaining market share? If yes, the stock will eventually follow. Stop watching stock tickers. Owners of private businesses don't obsess over minute-to-minute valuations. Neither should you. Celebrate when your stocks go down, if the business is still strong. Lower prices let you buy more of a good business, like a store putting your favorite items on sale. Principle 15, avoid excessive diversification. Buffett famously said, "Diversification is protection against ignorance." It makes little sense if you know what you are doing. He doesn't believe in owning 50 or 100 stocks. Berkshire's portfolio is concentrated in a relatively small number of companies. At times, his top 5 holdings have represented over 70% of his portfolio. Why? Because finding truly great businesses is hard. If you found 5 or 10 wonderful companies at fair prices, why dilute your returns by adding 40 mediocre ones? Buffett uses a striking analogy. I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it, so that you had 20 punches representing all the investments that you got to make in a lifetime, and once you'd punched through the card, you couldn't make any more investments at all. The lesson: if you had only 20 investment decisions in your lifetime, you'd think very carefully about each one. You'd research thoroughly. You'd wait for great opportunities. You wouldn't waste a punch on mediocre ideas. Of course, Buffett isn't suggesting reckless concentration. He's suggesting thoughtful concentration. There's a difference between owning 10 stocks you understand deeply versus owning 2 stocks you barely researched. Here's how you apply this. Focus on your best ideas. Rank all potential investments from best to worst. Invest most heavily in your top ideas. Don't equally weight everything. Start with 5 to 10 core positions. For most individual investors, this provides enough diversification without dilution. You can manage and understand 10 companies. You can't deeply know 50. Each position should be significant enough to matter. If you spread money across 40 stocks, a 50% gain in one barely moves your portfolio. But if that stock represents 10% of your portfolio, you'll notice. Make sure you deeply understand each holding. If you can't explain why you own something and what would make you sell it, you own too many things. Diversify across different business types, not just numbers of stocks. 10 tech stocks aren't diversified, but 10 stocks across different sectors, consumer goods, healthcare, finance, technology, energy, provide real diversification. For beginners, start with slightly more diversification, 15 to 20 stocks, until you build confidence and knowledge. As you improve, concentrate more. Remember Buffett's rule. It's far better to own a part of the Hope Diamond than 100% of a rhinestone. Principle 16, ignore macroeconomic predictions. Buffett doesn't make investment decisions based on economic forecasts, interest, rate predictions, or political outcomes. He says, we pay no attention to political or economic predictions, which are an expensive distraction for many investors and businessmen. Think about it. Economists can't reliably predict recessions, interest rates, or GDP growth. If experts who study this full-time can't predict these things, why would you base your investment strategy on them? Buffett invests based on individual business quality, not economic forecasts. During election years, people ask him which candidate would be better for stocks. His response is always the same. He doesn't know, and it doesn't matter to his investment approach. In his 1994 shareholder letter, he wrote, "We will continue to ignore political and economic forecasts, which are an expensive distraction for many investors and businessmen." 30 years ago, no one could have foreseen the huge expansion of the Vietnam War. Wage and price controls, 2 oil shocks, the resignation of a president, the dissolution of the Soviet Union, a one-day drop in the Dow of 508 points, or Treasury bill yields fluctuating between 2.8% and 17.4%. But, surprise, none of these blockbuster events made the slightest dent in Ben Graham's investment principles. Real example, Buffett bought Coca-Cola in 1988. Did he know what the economy would do in 1989, 1990, or 1991? No, but he knew Coke would sell beverages to billions of people regardless of economic conditions. Here's how you apply this. Stop reading economic forecasts and predictions. They're wrong more often than they're right, and they encourage short-term thinking. Focus on business fundamentals, not economic headlines. Ask, will people still want this product in a recession, in a boom, in high inflation, in deflation? Buy businesses that work in multiple economic scenarios. Companies selling essential products, businesses with pricing power, and companies with strong balance sheets do well across economic cycles. Ignore election year panic. Every 4 years, people worry about which party will win and how it'll affect stocks. Over the long term, stocks have gone up under every president and every party. Remember that you can't control the economy, but you can control what you own. Focus on what you can control. Use economic fear as an opportunity. When everyone worries about recession and sells stocks, that's often the best time to buy quality businesses at discounts. Principle 17. Patience is your greatest advantage. Buffett says one of his greatest competitive advantages is patience. While others chase quick returns, he's willing to wait years for the right opportunity. He compares investing to baseball with one key difference. The trick is, when there is nothing to do nothing. In baseball, you have to swing at some pitches. In investing, you can wait forever for the perfect pitch. Buffett bought almost nothing during the dot-com bubble of the late 1990s. For years, he sat on cash while everyone else got rich on internet stocks. People called him washed up, out of touch. Then the bubble burst. Buffett's patience paid off. He had cash when others had losses. He could buy quality businesses at bargain prices while others were financially devastated. He explains, the stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch. This patience extends to holding periods. Buffett has held some stocks for 40, 50, even 60 years. Most investors can't hold for 60 days without getting nervous. Here's how you apply this. Maintain a watch list of great companies you'd love to own at the right price. Then wait. It might take months or years for the price to reach your target. That's okay. Don't feel pressure to be fully invested all the time. If you can't find great opportunities at fair prices, hold cash. Cash is a position. It gives you options. Set price alerts instead of checking stocks daily. Use your broker's tools to alert you when a stock on your watch list hits your target price. Then ignore it until the alert triggers. Practice saying no to 99% of ideas. Out of 100 investment opportunities, maybe 1 or 2 deserve your money. Being selective is a superpower. Measure success by quality of decisions, not quantity of trades. Making 2 great investments per year beats making 50 mediocre ones. Remember that doing nothing is doing something. When you avoid bad investments by being patient, you're protecting your capital for the great opportunities. Warren Buffett's favorite quote about patience, the big money is not in the buying and selling, but in the waiting. Principle 18. Learn from mistakes. Buffett openly discusses his mistakes. He's lost billions on bad investments, and he shares these lessons in his annual letters. He believes transparency about errors makes him a better investor. Some of Buffett's biggest mistakes, Dexter Shoe Company Buffett bought. This shoe manufacturer in 1993 for $434 million, paying with Berkshire stock. He thought it had a durable competitive advantage. He was completely wrong. Foreign competition destroyed the business. He later called it a $3.5 billion mistake because the Berkshire stock he gave away became worth that much. IBM. Buffett invested heavily in IBM starting in 2011. He misjudged the company's competitive position in a rapidly changing tech landscape. He eventually sold at a loss, admitting his error. Airline investments in 1989, he bought U.S. Air preferred stock, and it turned into a disaster. He learned that airlines were terrible businesses, yet decades later, he invested in airlines again in 2016, Delta, United, American Southwest, before selling during COVID-19, calling it a mistake. Buffett says, it's good to learn from your mistakes. It's better to learn from other people's mistakes. What makes Buffett different isn't that he doesn't make mistakes. He makes plenty. It's that he, 1, admits them publicly. 2. Analyzes what went wrong. 3. Applies the lessons going forward. 4. Doesn't repeat the same errors. Here's how you apply this. Keep an investment journal. Record every buy and sell decision with your reasoning. Review it quarterly to see what worked and what didn't. When an investment loses money, ask why. Was your analysis wrong? Did the business change? Did you overpay? Did you panic sell? Learn the specific lesson. Don't hide from mistakes. It's tempting to sell losers and forget them. Instead, study them. Your failures teach more than your successes. Distinguish between bad outcomes and bad decisions. Sometimes you make a good decision and get unlucky. Sometimes you make a bad decision and get lucky. Focus on improving your decision-making process. Share your mistakes with others if you're in an investment club or have investing friends. Talking through errors helps solidify lessons. Create a mistake checklist. After each error, add a question to ask yourself before future investments. Over time, this prevents repeated mistakes. Remember Buffett's wisdom. What we learn from history is that people don't learn from history. Be different. Learn from your history. Principle 19. Understand your competitive advantage. Buffett knows his competitive advantages as an investor: patience, capital, long-term thinking, and ability to ignore market noise. But he also knows his limitations. He doesn't try to compete where he has no advantage. Buffett can't beat day traders at day trading. He can't beat algorithms at high-frequency trading. He can't beat sector specialists in industries he doesn't understand. But he has huge advantages. He can wait years for the right opportunity. He can hold stocks for decades. He has capital to invest when others are forced to sell. He's not measured on quarterly performance. He understands business fundamentals deeply. Individual investors have similar advantages over professional money. Managers, you don't have to report quarterly results to clients. You can invest in small companies institutions ignore. You don't face redemptions forcing you to sell at bad times. You can wait decades for investments to work out. You can be 100% in cash if nothing looks good, but you must know your limitations too. You probably don't have advantages in processing information faster than algorithms, trading more frequently than professionals, analyzing complex financial instruments, predicting short-term market movements. Here's how you apply this. List your genuine advantages. Maybe you work in an industry and understand those businesses better than outsiders. Maybe you have a long-time horizon. Maybe you can remain calm when others panic. Invest in ways that use these advantages. List your disadvantages or limitations. Maybe you can't follow 50 companies closely. Maybe you don't understand technology. Maybe you get emotional during market swings. Avoid investing in ways that expose these weaknesses. Play your own game. Don't try to beat hedge funds at their game. Beat them at your game. Your game might be buying wonderful small businesses and holding them for 20 years. Focus on areas where you have insight others lack. This might be local businesses, industries you work in, or business models you understand deeply. Avoid your too hard pile. Buffett has a mental pile of businesses that are too hard for him to understand. He doesn't feel bad about this. He focuses on what he does understand. Remember that your greatest advantage over Wall Street is time. You can wait. They often can't. Principle 20. Stay rational when others aren't. This is perhaps Buffett's most important principle. Markets are driven by human emotions, fear, and greed. The ability to stay rational when everyone else is panicking or euphoric is what separates great investors from average ones. Buffett says, success in investing doesn't correlate with IQ once. You're above the level of 125. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. In 2008, when banks were collapsing and the world seemed to be ending, Buffett was calm and rational. He saw opportunity while others saw apocalypse. In 1999, when everyone was convinced internet stocks would rise forever and Buffett was criticized for being old-fashioned, he stayed rational. He knew that businesses need profits eventually. In March 2020, when COVID-19 crashed markets, rational investors recognized that many great businesses were temporarily on sale. The investor's greatest enemy isn't the market, it's themselves. Emotional decisions destroy more wealth than bad companies. common emotional mistakes, panic selling during crashes, FOMO buying during bubbles, holding losers hoping they'll recover, selling winners too early to lock in gains, following the crowd instead of thinking independently. Here's how you apply this. Create rules before emotions strike. Decide now what you'll do when the market drops 30%. Write it down. When it happens, follow your plan instead of your emotions. Recognize that volatility is normal. Stocks go up and down. If you can't stomach a 20% decline without panicking, you shouldn't be in stocks. Use emotional extremes as signals. When you feel euphoric about a stock, be cautious. When you're terrified, consider buying. Your emotions are often wrong. Avoid checking your portfolio during emotional times. If you can't handle seeing red numbers, don't look. Focus on the businesses you own, not daily price changes. Build an emotional support system. Have investing friends or mentors you can talk to during volatile times. They can help you stay rational. Practice with small amounts first. If you can't stay rational with $1,000 invested, you won't stay rational with $100,000. Build emotional muscle with smaller stakes. Remember that the market is designed to transfer money from the emotional to the rational. Which side do you want to be on? Buffett's advice. The most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. We've just covered the 20 principles that turned Warren Buffett from a kid delivering newspapers in Omaha into one of the richest people who ever lived. Let's recap the core principles, 1 to 5. Invest in what you understand. Buy wonderful companies at fair prices. Think long term. Look for economic moats. And be greedy when others are fearful. 6 to 10. Demand a margin of safety. Focus on quality management. Understand the difference between price and value. Don't try to time the market and keep it simple. 11 to 15. Focus on cash flow. Not just earnings, reinvestment returns matter. Understand business economics, invest in businesses, not stocks, and avoid excessive diversification. 16 to 20. Ignore macroeconomic predictions. Patience is your greatest advantage. Learn from mistakes, understand your competitive advantages, and stay rational when others aren't. Here's what's remarkable. Warren Buffett has shared these principles openly for over 60 years. They're not secrets. He publishes them in his annual letters, talks about them in interviews, and teaches them at universities. Yet most people don't follow them. Why? Because they're simple, but not easy. They require patience in a world that demands instant results, rationality when emotions are screaming, long-term thinking in a short-term world, discipline to do nothing when everyone else is active, courage to act when everyone else is afraid. The good news, you now know these principles. You understand them. The question is, will you apply them? Here's your action plan. This week, define your circle of competence. List industries and businesses you truly understand. This month, create your watch list of 10 wonderful companies you'd love to own at the right price. Research them deeply. Calculate what they're worth. This quarter, make your first Buffett-style investment. Buy a wonderful business at a fair price that you're willing to hold for 10+ years. This year, build your forever portfolio. 5 to 10 companies you deeply understand with strong moats, great management, and solid economics. Over your lifetime, apply these principles consistently. Be patient, stay rational, think long-term. Learn from mistakes and watch your wealth compound. Remember Buffett's most powerful insight. Someone is sitting in the shade today because someone planted a tree a long time ago. Plant your financial trees today by applying these principles. Your future self, sitting in the shade of financial security, will thank you. Before you go, here's what you should do next. Download the full ebook version of this guide. It includes detailed worksheets for each principle, calculation templates, and checklists you can use for every investment decision. The link is in the description. Second, if you found value in this video, share it with someone who's serious about building wealth. These principles can change lives, but only if people know about them. Third, subscribe to this channel for more deep dive content on investing, wealth building, and financial independence. We cut through the noise and focus on what actually works. And finally, leave a comment below. Which of these 20 principles resonated most with you? Which one will you apply first? I read every comment and often create follow-up videos based on your questions. Warren Buffett proved that you don't need to be the smartest person in the room to build extraordinary wealth. You need to be rational, patient, and disciplined. You need to follow proven principles, even when they're unpopular. You now have those principles. The only question left is, what will you do with them? Thank you for watching. Now go invest like Buffett.